Ignore the news.
Your portfolio did not match the S&P 500 because you didn't hire me to match the S&P 500.
The people who tend to time the market, they never tell you the stories of the losers. What are some of the best investments to beat inflation?
I also don't know how risky I should get if I want to retire in the next decade.
The stock market has been proven to be the best way to beat inflation, but determining the mix that you need is more important than necessarily just basing your entire investment strategy in beating inflation.
We have to look at your own financial plan. We have to make sure that if you're going to retire in 10 years, that if we were to see a big drawdown in the stock market, that doesn't derail it. But most people that are a decade out from retiring should have 50, 60, 70, maybe even 80% of their portfolio. And even if you're going to retire 10 years out, you don't sell everything on day one of retirement and use it. It's still a long-term plan to get that money to last decades. So that's where you do need stock exposure, not just to retirement, but through it.
I know it's been the buzzword of the past 5 years, inflation, 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 simply because we have not seen inflationary times in a very long time. So if you're somebody who's my age, this is the first time really you are dealing with inflation, period, right? So with that being said, I understand how it's top of mind, but it is one economic measure.
The beauty about inflation is it's always ever present. And historically, whether clients like to hear this or not, the equity market historically has outpaced inflation. So not everyone needs to be in an all equity portfolio, but as you're trying to create a client's goal, you try to find what section of their portfolio needs to be the inflation buster side versus the steady Eddie side.
A lot of people kind of get caught up in this. I just need to invest until I retire and then I'm there. Well, you're not done yet. You're not finished just because you retired. You have to keep that money invested. And you also have to keep that money invested in a way that it's growing to outpace inflation.
Someone's appetite for risk completely depends on the person. If they have a stock market portfolio and they see big fluctuations, if that causes anxiety or lost sleep or panic or making them make a bad decision and to sell out of it when it's down, they can't be that risky. So you do have to have an honest assessment of someone as a person to know what they can tolerate.
Your age should not determine necessarily your risk level. When you effectively look at it, it's the amount you need of your account and how soon. You have some 80-year-old clients who are still very aggressive because they're the stewards of those accounts for the next generation because they're taking out such little of their accounts they can handle risk level. What I try to caution people is if you're just trying to have excessive risk to die with the most toys, you're never going to be happy.
Try to focus on the long term. Try not to focus on the short-term fluctuations in the market and being afraid of the daily ups and downs or the market cycles that you see. Focus on that long term and try to not look at it, right? You're gonna look at it and you should look at it, but try not to look at it so often and worry about the fluctuations, the downside fluctuations.
Inflation has been such a hot topic right now. What a lot of people need to realize is inflation is actually healthy for a growing economy. It means that things are getting a little bit better. Hopefully salaries are catching up a little bit better, which means that the companies that sell us these things are realizing they can move the price point just a little bit and we can handle it. So if we are seeing a little bit more price increases and, not what we have seen over the past few years, but just that tick a little bit in the cost of goods and services means we actually have a vibrant, healthy economy for the most part. Economies that don't inflate usually are very stagnant and then it goes the other way.
I know what the worst investment is for beating inflation, and that's basically cash. So anytime you have a diversified portfolio that has stocks and bonds and maybe cash and real estate and all the things that make up a really well-diversified portfolio, you've got a much higher likelihood of beating inflation than you do if your money is sitting in cash.
So if we are in a high inflation environment, I think it does impact someone's risk tolerance in the way that I I would probably encourage them to have some more stock exposure. We can't be terribly excited that high yield savings accounts are paying 4 or 5% if that's what inflation has been. It's a zero real return. So that's where you have to look at what is your return above inflation and make sure you're not just keeping pace with it, but that you are beating it.
For the past 4 years, we've been in this political campaign that is really honed in on inflation, which means every channel, every radio station, local reporters are going to see what the price of eggs and bacon is and bringing that to the forefront of it. And we are what we absorb.
I would remind someone who's concerned about inflation that inflation has always been around. Inflation exists. Sometimes it's high, sometimes it's low. We just have to roll with it. We've been in a very low inflationary environment for a decade before 2022 came around. So it was really shocking to see inflation. We haven't had any. But the reality is that, when we look at long-term averages, we're really right there. It just hurts in the immediate aftermath of seeing really high inflation because you've seen the prices go up and then you don't see them go down. The point of investing is to have something that's going to outpace inflation. So as long as you are continuing to invest, you're continuing to grow your money in the right way for you, you're putting money away into your 401k, and you're focusing on that long term, lots of stuff is going to happen in the short term.
Inflation is ever present. The longer you live, the more it's going to rear its ugly head. And historically, if inflation is 3%, it really means it's going to cause your needs to double every 20 years. So effectively, if your needs are $50,000 at 50, by the time you're 70, it's $100,000. Inflation, taxes, and longevity are probably more your enemy than market swings.
Markets go in cycles, and sometimes it's up, sometimes it's down, sometimes it's sideways. But we like to say it's like walking up the hill with a yo-yo. It's up and down, but eventually you're going to get to the top of the hill. And the top of the hill isn't retirement. The top of the hill is the rest of your life, right? So you got a long time. So focus on growth within reason, given your risk profile.
I made some money off my portfolio in 2024.
But it didn't match how well the market did overall.
I worry that with how bad inflation has been, I didn't really make much at all.
How can I optimize my investments to beat inflation?
The market is not your measure. Like how well or how bad the market has done is not really the measure you should be using to see if you're doing well or you're not doing well.
It's easy to look at the S&P or the Dow because those are the main indices people see and say, oh, the S&P did 20%. Why have I only done 10? You probably have a highly diversified allocation. Most financial planners build a portfolio where you don't just have US large cap stocks. That's one or arguably two asset classes, large growth and large value. We want clients to own large cap as well as small. We want clients to own medium-sized companies. We want clients to own international as well as US, emerging markets as well as developed nations. We want other asset classes like real estate, perhaps commodities. So if you're going to compare performance of a portfolio, you have to compare it to a diversified portfolio, what the performance of that would do. You have to look at all those other indices versus just compare to the S&P 500.
So when a client says market, they typically mean the S&P 500. So I have to use that to go, you're absolutely right. Your portfolio did not match the S&P 500 because you didn't hire me to match the S&P 500. If you're on track for your goal of retiring comfortably, not running out of money, helping your kids, helping your parents, don't worry about what the benchmark is. Your risk relative to your goal matters.
And you want to own all asset classes all the time because that really helps smooth out the bumps. Yes, you don't see as high of highs, but you also don't see as low of lows, and it helps be a little bit more of a consistent return.
You own more than just the S&P 500 or the Dow Jones or the NASDAQ. And so one of the first things that I try to do with people is help them understand, look, you may have made a lot more than you think, because what you're actually trying to do is compare this basket of fruit to one particular piece of fruit. So you've got apples and oranges and bananas and limes and all these things, and you're beating yourself up because it didn't do as well as just the one apple or the one orange or anything else.
The best way to beat inflation really is to invest and stay invested and get a good, consistent rate of return throughout your investment life and even throughout the distribution stage of your life, because we have not seen a period in which inflation has been way above what you could get with your investment. So therefore, keeping pace with inflation really means staying consistent in the strategy that you have.
What do you got coming in? What do you got going out? When do you need to start spending that money? Because in retirement, there'll be some mailbox money, right? With Social Security, maybe some pensions, maybe some part-time income. But at some point, you're going to be paying your own retirement paycheck. And so you have to figure out what's the least amount of risk that I need to be taking on now so that I can support my lifestyle as I move into and all the way through retirement. It could be that you probably don't need to make any change, right? You just need to save more. It could be that, hey, you're living a little bit high here and you need to tone down those costs. Until you figure out what your income is, what your expenses are, how long retirement might be, you can't really optimize any investment.
You give me your stay rich money and you keep your get rich money. It is not wise to try to game the market, to try to outperform the market with your entire wealth. Because if you slip up and make a huge mistake, now, you find yourself in situations you don't want to be in.
I'm okay from an educational perspective on someone staying active to some extent, and it may be what they feel to be a small amount of their play account, whatever they want to call it. And quite frankly, I hope your play account beats me all day long. That's okay. My job is to find kind of the just boring enough to be effective for your goal, and it's okay to investigate and have your finger on the pulse of the market with this play account. I don't have a problem with that. I do have a problem though when you say, Jason, my play account is up 40%, why are you only up 10? Well, because I'm not trying to take the same risk that you are, nor did you hire me to do that. That's not an apples to apples comparison.
The people who tend to time the market, they never tell you the stories of the losers. They are going to keep you at the bar, at the barbecue, at the family functions, talking about that one stock that they timed right in 1974, and they never tell you the hundreds that they've gotten wrong, right? So keep the money you think you can use to get rich, and I can help you determine that based on the goals that you have. Hey, this is the pot of money you can play with. And then give a financial professional the money that you need to actually maintain your lifestyle.
People like seeing a really big number in savings. It's a security blanket. It's them kind of planting a flag in the ground and saying, this is how much I have. So if everything falls apart, right, at least I have this in savings. So then what I do is I start looking at and pulling up different inflation numbers. All right, and whatever it is, wherever you get the number, but basically take that number, put a negative sign in front of it. That's how much money you effectively lose the longer you have money in cash. Now, over the last couple of years, it's been great because we've seen money markets and high yield savings at 4.5%, 5%, 5.25%. What's the likelihood that that's going to continue? I don't know, but maybe not that great, right? So people have this money in cash. They feel really good about the 5% that they're earning on it. But when inflation's 7, 8, 9%, well, it's a math problem, right? You earn 5, you lose 8. Well, now you're down 3, but you feel really good because you got this cash in the bank.
Ignore the news. Just kidding. You have to listen to the news. You have to be informed, but you can't let what you hear on the news make you change your plan.
So don't, again, take numbers that are external and have them determine whether or not you're doing well.
We don't want to be making bets with your life savings. We want to go back to your goal. The goal is what we're striving for.
Investments are just a tool. They're a tool that helps make your cash flow plan work. There's no one magical investment. There's no one magical annuity contract or basket of stocks or anything else. It's finding the least amount of risk necessary for you to reach your long-term goals.